Reminiscences of a Stock Operator. Edwin Lefevre. The Tale of the Bucket Shop and the Rising Price. In the early days of Jesse Livermore's trading career, he frequented bucket shops, which were small brokerage firms where traders could bet on stock price movements without owning the stocks. These shops catered to small traders and operated in a highly speculative and often dishonest manner. Livermore, armed with a keen sense of market patterns and an ability to read the tape, started making small but consistent profits in these bucket shops. One day, he noticed a stock that had been moving steadily upwards. He decided to buy and ride the trend. True to his instincts, the stock continued its upward trajectory, and Livermore was in the money. However, the bucket shop owners, realizing they were losing money to this young trader, started to manipulate the prices. They knew they could not allow Livermore to continue his winning streak. They made it increasingly difficult for him to place orders and even manipulated the prices against him to create artificial losses. Despite these manipulations, Livermore's skill in reading the tape and understanding market psychology allowed him to anticipate these moves. He managed to avoid the traps set by the bucket shop operators and continued to make profits. Eventually, realizing that the bucket shops were too restrictive and dishonest, he moved on to the legitimate stock exchanges where the opportunities and stakes were higher. This experience taught Livermore several crucial lessons. Understand the environment, know the nature of the market you are trading in and be aware of potential manipulations. Pattern recognition. Recognizing patterns and trends is vital for successful trading. Adaptability. Adaptability to changing conditions and manipulations can save a trader from losses. Progression. Sometimes, moving to a more challenging environment is necessary for growth. This early phase in Livermore's career laid the foundation for his later successes and established key principles he would adhere to throughout his trading life. This story from Reminiscences of a Stock Operator encapsulates the importance of understanding the market, recognizing patterns, and being adaptable in the face of manipulation and adversity. The cotton trade and the power of patience. One of the most famous episodes in Jesse Livermore's career was his cotton trade. By this time, Livermore had moved beyond the bucket shops and was trading on the larger exchanges with significant capital. Livermore had been carefully studying the cotton market and became convinced that cotton prices would rise. He started buying cotton futures in large quantities. In response to a pricea increase, he continued accumulating his position, confident in his analysis. However, the market began to move against him, and the price of cotton started to decline. Many traders in Livermore's position would have panicked and sold their positions to avoid further losses. But Livermore had a strong conviction in his analysis. He believed the decline was temporary and that the fundamentals supported a rise in cotton prices. Livermore held his position despite the mounting pressure and skepticism from other traders. He was patient and waited for the market to turn in his favor. Sure enough, after a period of consolidation and a lot of waiting nervously, the price of cotton began to rise again. Livermore's patience paid off, and the price soared to new highs, allowing him to make a substantial profit. Conviction and patience. Strong conviction in your analysis and the patience to see it through are essential qualities for a successful trader. Handling pressure. The ability to withstand market pressure and skepticism from others can be crucial when you believe in your position. Fundamental analysis. Understanding the fundamentals of the market you are trading in can give you the confidence to hold your position during challenging times. The Union Pacific trade and the importance of timing. Another notable story involves Livermore's trade in Union Pacific stock. Livermore was always on the lookout for patterns and trends, and he had a knack for identifying opportunities before others. Livermore observed that Union Pacific stock was behaving unusually. After conducting his analysis, he concluded that the stock was about to experience a significant upward movement. He began buying shares in large quantities, positioning himself for what he believed would be a big move. Sure enough, Union Pacific stock started to rise rapidly. Livermore's timing was impeccable. He continued to buy on the way up, confident that the stock had more room to grow. The stock's rise was meteoric, and Livermore's profits were substantial. However, Livermore understood that timing was not just about buying at the right moment but also knowing when to sell. He watched the stock closely and began seeing signs that the upward momentum was slowing. As a result, he began selling his position, locking in his profits before the inevitable pullback. Livermore's trade in Union Pacific taught the following. Timing the market. Successful trading often hinges on the ability to time both the entry and exit points correctly. Riding the trend. Once in a profitable position, it is important to maximize gains by riding the trend but also be vigilant for signs of reversal. Knowing when to exit. Exiting a trade at the right time is just as crucial as entering it at the right time. Recognizing the signs of a trend's end can protect profits. These stories from Reminiscences of a Stock Operator highlight the importance of patience, conviction, timing, and the ability to handle market pressure, all crucial traits for a successful trader. The Corn Corner and the Dangers of Market Manipulation. One of the most dramatic episodes in Jesse Livermore's career involved an attempt to corner the market in corn. Livermore had teamed up with several other traders to manipulate the market by buying a significant portion of the available corn futures. Their goal was to create a shortage, drive up prices, and sell at the peak for massive profits. Initially, the plan worked well. As they bought more and more futures contracts, the price of corn began to rise. However, as the price climbed higher, they encountered a problem. The market had noticed their manipulation, and other traders started to bet against them. The increased scrutiny led to regulatory actions and forced the team to liquidate their positions. Ultimately, the manipulation failed, and Livermore and his partners suffered significant losses. This experience taught Livermore several critical lessons. Market manipulation. Attempting to manipulate the market can lead to significant financial and legal risks. The market is larger and more complex than any individual trader or group. Transparency and regulation. Regulatory bodies exist to maintain market integrity, and attempting to circumvent these regulations can have serious consequences. Ethics in trading. Ethical trading practices are essential for long-term success and reputation. The 1907 Panic and the Power of Observation. In 1907, the stock market experienced a severe panic. Banks were failing, and stock prices were plummeting. Many traders were in a state of panic, selling their holdings at any position to cut their losses. However, Jesse Livermore saw this as an opportunity rather than a disaster. Livermore had observed that during times of panic, markets often overreact and create opportunities for those who can remain calm and think clearly. He decided shorting the market, betting that the prices would fall even further before stabilizing. His observation proved correct. As the panic continued, stock prices fell sharply, and Livermore profited substantially from his short positions. When the market finally began stabilizing, he covered his shorts and started buying stocks at their new, lower prices, positioning himself for the subsequent recovery. This episode underscores several important principles. Observation and analysis. Keen observation and analysis can provide significant advantages in understanding market behavior. Contrarian thinking. Being willing to go against the crowd during panic or euphoria can lead to substantial profits. Staying calm under pressure. Remaining calm and thinking clearly during market turmoil is a critical trait for successful trading. The sugar stock and the importance of research. Livermore's trade in sugar stocks is another classic example of his analytical skills and attention to detail. Livermore had been following the sugar market closely and noticed that the prices were low despite strong fundamentals. He decided to investigate further. Livermore spent days researching the sugar industry, talking to experts, and analyzing production and consumption data. He concluded that the low prices were unjustified and the stock was due for a significant rally. Confident in his research, Livermore began buying sugar stocks. As he had predicted, the market eventually realized the value of the sugar stocks, and the prices started rising. Livermore's thorough research paid off handsomely, and he made a significant profit from the trade. This story highlights the following. Thorough research. conducting thorough research and understanding the fundamentals of an industry can provide a significant edge in trading. Patience and timing. Having the patience to wait for the market to recognize the value of an undervalued stock is crucial. Confidence in analysis. Confidence in one's research and analysis can lead to successful trades, even when the market initially disagrees. These stories from Reminiscences of a Stock Operator illustrate the importance of research, observation, ethical trading practices, and staying calm under pressure, each a vital component of successful trading. The Great Bear Raid on Union Pacific. One of Jesse Livermore's most famous trades was his short position in Union Pacific during the Great Bear Raid. Livermore had noticed that Union Pacific stock was highly overbought and due for a correction. He decided to take a significant short position, betting the stock would fall. At first, his position seemed risky. The market was bullish, and Union Pacific continued to rise. However, Livermore's analysis told him that the rise was unsustainable and that a major correction was imminent. He held his short position, staying patient and confident in his research. One morning, news broke that the financial health of Union Pacific was not as robust as the market had assumed. Panic ensued, and the stock began to plummet. Livermore's short position paid off spectacularly as Union Pacific's stock price dropped sharply, and he made a huge profit. This episode taught several lessons. Contrarian thinking. Going against the prevailing market sentiment can be highly profitable based on solid analysis. Patience and conviction. Holding a position through adverse movements requires patience and confidence in research. Market timing. Understanding when a market is overbought or oversold is critical for timing entries and exits. The Anaconda Copper Stock and Market Psychology. In another famous trade, Livermore focused on Anaconda Copper Stock. He noticed the stock was behaving erratically, with sharp rises and falls, indicating high volatility. Livermore began to study the stock's price movements and the psychology driving its trading. He realized that the market was to react emotionally to news and rumors about the copper industry and Anaconda's business operations. Livermore decided to exploit this by taking a long position when the stock was driven down by fear and selling short when it was driven up by irrational exuberance. Using this strategy, Livermore made several profitable trades, buying low when others were fearful and selling high when others were greedy. This approach allowed him to capitalize on the market's emotional swings. Understanding market psychology, recognizing and exploiting the emotional reactions of other traders can lead to profitable opportunities. Volatility as opportunity. High volatility can be an advantage if one can stay disciplined and execute trades based on rational analysis rather than emotions. Flexible strategy. Adapting one's strategy to the market conditions and the behavior of other traders is essential for success. The Hutton & Co. trade and the value of inside information. Livermore's trade with Hutton & Co. is another illustrative example. Hutton & Co. was a brokerage firm, and Livermore had a close relationship with them. He often received valuable market insights and tips from his contacts there. One day, Livermore received a tip that a particular stock would be heavily promoted by the firm. Anticipating a significant rise in the stock's price due to the upcoming promotion, Livermore bought a large position before the promotion began. As predicted, once Hutton & Co. started promoting the stock, the price soared, and Livermore made a substantial profit. However, he was careful to sell his position before the promotion ended and the stock price inevitably corrected. Information advantage. Having timely and reliable access to information can provide a significant edge in trading. Timing the market. Knowing when to enter and exit based on information flow is crucial for maximizing profits and minimizing risks. Ethics and regulations. While this story highlights the power of inside information, it also serves as a reminder of the importance of adhering to ethical standards and regulations in trading. These stories from Reminiscences of a Stock Operator further emphasize the importance of contrarian thinking, understanding market psychology, leveraging information, and maintaining ethical practices in trading. Each episode in Livermore's career provides a rich source of learning for traders and investors. The story of Bethlehem Steel and the importance of liquidity. Jesse Livermore once took a significant position in Bethlehem Steel, a heavily traded company and well regarded in the market. Livermore noticed the stock was showing strong upward momentum, supported by solid fundamentals and favorable market conditions. He decided to buy a high volume of shares, confident that the stock would continue to rise. At first, Livermore's trade went as planned, and the stock rose steadily. However, as the stock price climbed, he realized that the market was becoming less liquid, with fewer buyers and sellers willing to trade at the higher prices. This lack of liquidity made it difficult for Livermore to exit his position without causing a significant drop in the stock price. When Livermore decided it was time to take his profits, he struggled to sell his large holding without impacting the market negatively. Despite his best efforts, the stock price started falling as he tried to unload his shares. Livermore made a profit, but the experience taught him a valuable lesson about liquidity. Importance of liquidity. Trading in liquid markets is crucial for entering and exiting positions without significantly affecting the price. Impact of large positions. Positions can be risky if the market is not liquid enough to absorb the trades. Market dynamics. Understanding market dynamics, including liquidity, is essential for successful trading. The wheat market and the dangers of overtrading. Livermore had a notable experience trading in the wheat market. He identified a clear uptrend in wheat prices and took a substantial long position. Confident in his analysis, he bought heavily, expecting the prices to continue rising. Initially, the trade was successful, and Livermore's position was profitable. However, as prices continued climbing, Livermore became overconfident and added more to his position, leveraging his trades heavily. He believed that the uptrend would continue indefinitely and that he could maximize his profits by continuously increasing his exposure. Unfortunately, the market dynamics changed, and wheat prices began declining rapidly. Livermore's heavily leveraged position turned against him, leading to significant losses. His overconfidence and overtrading had turned a profitable trade into a costly mistake. From this experience, Livermore learned important lessons. Avoid overtrading. Overtrading and excessive leverage can turn a winning position into a losing one. Manage leverage. Use leverage cautiously and avoid becoming overexposed to any trade. Stay disciplined. Maintain discipline and stick to your trading strategy, even when trades are going well. The story of the insider tip on tobacco. Livermore once received a tip from a reliable insider source about a significant upcoming development in the tobacco industry. The tip was that a major tobacco company was about to release a groundbreaking new product that revolutionized the market. The source assured Livermore that the information was accurate and that the stock price would soar once the news became public. Livermore, usually cautious about insider tips, decided to act on this one because of its credibility. He bought a large position in the tobacco company's stock, anticipating a significant rise once the announcement was made. However, days turned into weeks, and no such announcement was forthcoming. The stock remained stagnant, and Livermore's large position tied up substantial capital that could have been used elsewhere. Eventually, Livermore decided to cut his losses and exit the position, frustrated by the lack of results from the supposed insider information. The key takeaways from this story are: skepticism of insider tips. Even reliable sources can be wrong or misinformed. Always approach insider tips with caution. Opportunity cost. Holding a non-performing position can prevent you from capitalizing on other opportunities. Risk management. Manage risk by not relying too heavily on tips and rumors. Make decisions based on solid analysis. These additional stories from Reminiscences of a Stock Operator highlight the importance of liquidity, the dangers of overtrading, the skepticism required for insider tips, and the critical nature of risk management in trading. Each experience of Jesse Livermore offers valuable insights for traders and investors.